Good morning, everyone, and welcome to the UBS US Monday Macro Call. My name's Abigail Watt. I'm one of the economists in the team here, and today I'm joined by my colleagues Alan Detmeister and Amanda Wilcox. Today we're going to run through the events of last week and what we're looking out for in the week ahead, and then I'm going to cover the topic from our economic comment, which was published in our weekly on Friday. This is an area we've been getting a lot of questions from clients, so we're going to walk through kind of the potential labour market implications of DOGE and some of the new policies of the administration, particularly focusing on the outlook for government employment. But first, I think we'll start with the main events of last week. So Amanda, do you think you could quickly take us through the key things that stand out from last week?
Yeah, thank you, Abby. Good morning, everybody. So the main events of last week that I'll be speaking about this morning include news flow continuing out of Washington, including some more tariff propositions from President Trump, and the Senate passing a budget resolution. And of course, there is ongoing news flow surrounding federal government employment, but Abby later in the call will be speaking in more detail about how all of those policies accumulate and contribute towards our government employment outlook. And then secondly, FOMC communications last week included the January FOMC meeting minutes and a number of speeches. And these were all consistent with a committee that is content to wait before deciding what to do next. And the data flow was fairly light, including some soft PMI and housing data. But the final February data from the University of Michigan Consumer Survey was worth watching. And there, the 5 to 10 year inflation expectations measure climbed, potentially ominous for the FOMC, but with some caveats, which I will detail last. So starting out with the news out of the White House and Capitol Hill. Last week, Reuters reported that President Trump said that he was considering potential tariffs on specific industries, being autos, pharmaceuticals, and semiconductors, quote, in the neighborhood of 25% as soon as April 2nd. While the detail is relatively sparse thus far, these three categories together comprised about 20% of U.S. imports last year. Leading suppliers of autos and parts were Mexico and the European Union, with Switzerland and Germany supplying the largest share of pharmaceuticals, and Malaysia and Taiwan were the largest suppliers of semiconductors. So recall that the federal agency reviews that are part of the America First trade policy are due April 1st, and more details on the reciprocal tariff proposal that was put forward by the president last week are also expected then. Bloomberg also reported last week that the president had noted a possible trade deal with China and mentioned considering tariffs to counter digital services taxes that some countries place on U.S. tech companies. And then also last week from Capitol Hill, the Senate moved forward with the reconciliation process, passing a $350 billion budget resolution, increasing spending on defense and border security while leaving aside tax code extensions. The House is in recess, but could potentially vote on its own budget resolution as early as this week, which addresses administration priorities and also the expiring tax provisions. We've noted that the instructions from the Ways and Means Committee specifying a maximum of $4.5 trillion in deficit widening don't leave a lot of room for tax cuts because, of course, extending the Tax Cuts and Jobs Act So that sums up the political news. And moving on to last week's FOMC communications. We received the minutes of the January meeting last week, and those generally didn't break a lot of new ground as far as monetary policy is concerned, with the FOMC widely expected to stay on hold at their next meeting. The broader sentiment in the meeting seemed to be that the FOMC wants to wait and see if inflation improves before they resume with rate cuts. Interestingly, the minutes only mentioned the word tariff once, alongside some general references to trade and immigration as an upside risk to the inflation outlook. And we would have guessed that the discussion at the meeting about trade and fiscal policy would have been more robust than the couple of mentions in the minutes might suggest. But the news in the minutes was more about other topics, such as the staff delivering a presentation on balance sheet runoff, suggesting changes may be approaching, and participants commented on slowing the pace of runoff, given that the debt ceiling could lead to swings in reserve balances as the TGA is drawn down and then later replenished. And the FOMC also began its discussion of the 5-year strategic review of monetary policy that will take place this year. And then Fed speeches last week again suggested that the committee is comfortable waiting before adjusting policy, as we've generally been expecting. Governor Jefferson, in particular, emphasized the strong labor market, and FRB of Atlanta President Bostic noted the importance of taking the combination of fiscal policies as a whole in considering policy. FRB of St. Louis President Musalem expressed concern on the risk of progress in inflation stalling, and that policy changes concerning immigration and tariffs could have a material impact on the economic outlook. And he noted that his district is already reporting labor market tightness in sectors such as construction. However, Governor Waller sounded more sanguine on the anticipated inflation trajectory, despite the recent upside surprises. So I'll close out with the final February data from the University of Michigan Consumer Survey. The UMich estimate of 5 to 10 year ahead median inflation expectations increased 0.3 percentage points from 3.2% in January to 3.5% in February. And that included a 0.2 percentage point upward revision from the preliminary February estimate. And this was the highest reading for the series since April 1995. Meanwhile, the year ahead measure increased 1 percentage point from January to February to 4.3% in the final February data. Now, this comes with some caveats. Abby has done some analysis on the recent shift in survey methodology to online sampling, which she found could add to both the volatility and the level of median inflation expectations. And she noted that this change has seemingly come with an increased share of respondents reporting more extreme inflation expectations. For instance, in the data on Friday, 13% of respondents reported expectations for prices to go up more than 15% during the next 5 years, for example. And despite that caveat, the change in methodology, which is very worth keeping in mind when making longer run comparisons, especially before and after the change, the trend in expectations at both the 1 year and the 5 year horizons could look worrying to the FOMC, given the fact that their ability to look through shocks such as tariffs depends crucially on inflation expectations remaining anchored and not adding on to the level shift in prices. So that's it from me. Back to you, Abby. Thank you.
Thanks, Amanda. And yeah, I think you're totally right to kind of note the potential for the House vote on the budget resolution this week. Obviously, we've seen different strategies from the House and the Senate so far in terms of the reconciliation process, with the Senate looking to focus on kind of spending priorities and leave more difficult, potentially, tax discussions to a kind of another bill later this year. Whereas the House have moved forward with their kind of single omnibus bill, which actually last week did garner the support of the president as well. Now, the progress on the House is going to be an important waymark just in terms of knowing kind of which approach is going to prevail. So that's definitely something that we'll be watching out for this week. I think the other thing that we'll be watching, obviously, is the kind of PCE inflation data that we'll be getting on Friday, where we're expecting to see some more progress despite some of the kind of stronger prints in the CPI in January. So, Alan, do you want to take us through your expectations for PCE prices later this week? And also, you published an updated inflation monthly. So, do you want to share some of the highlights from that too?
Yeah, thank you, Abby. So, we are looking for a core PCE inflation at 26 basis points in the January. Apologies, that have November written there. 26 basis points in the January data, with the 12-month change edging down from 2.7 2.8% to really the borderline of 2.5 and 2.6. We've currently got it rounding down to 2.5%, but with the standard error of a bit more than 3 basis points for the core PCE number, between 3 and 4 basis points, that could as easily be a 2.6 as a 2.5 number there. But that coming down to that borderline of 2.5, 2.6 for the 12-month core PCE change, that is pretty good progress from the 2.8 that we've seen. And we expect that progress to continue over the next couple months. That 2.6, 2.5 would be right at the bottom edge of the range that we've seen since the start of the pandemic, or that big surge in inflation in 2021, and puts us back to just a few basis points below where we were at in the bottom at summer of last year. Now, for the headline PCE prices, we're looking for something around 30 basis points in Friday's data that would have the 12-month change fall into right about 2.4%. That's still above where we were when we got down to 2.1% in the past summer, but it's kind of starting to get close to that Fed's 2% target. Now, that, as Abby mentioned, that 26 basis points for the core PCE is well below where we were in the January data for the core CPI changes. And there are significant differences between the two different inflation index. And we've gotten a lot of questions on that recently. In the most recent inflation monthly, we went through some of those differences between the two indexes. In particular, there are significant differences in the scope of the index, with the CPI focusing on out-of-pocket expenditures, PCE prices focusing on prices of all consumption by U.S. residents as well as nonprofits in there. Differences in how they change in the weights of those components. The formula differences create a little bit of an upward bias in the CPI compared to PCE prices, as well as differences with how owner's equivalent rent is sampled and some of the source data. The source data this time is the really big difference between them. Those components coming from the PPI, which are around 15% of PCE prices, which includes your medical components, your airfares, and financial services, which are those components from the PCE that are coming from the PPI. Those have been coming in notably weaker than the CPI, their CPI counterparts. This kind of highlights the fact that there really is no true right measure of prices out there. And all these little choices that you could make on your scopes, your weights, your formula, and exactly the surveys themselves really can lead to a different inflation measure. Now, right now, the Fed focuses mostly on PCE prices. And if we're right and we're getting PCE inflation coming down pretty solidly this month, we expect it to get to around to about 2.4% by the release of the March data that comes out in April. Then we're starting to make some decent progress on inflation. Now, overall, our forecast for this year still ends the year at 2.4%. So most of the progress that we expect on inflation will be happening in just these next couple of months. And then after that, we're not expecting to see a lot more improvement on the inflation data between now and the end of the year, still ending at 2.4%. Our forecast is within the range of what we've been seeing in most of the consensus measures for 2025, but we're a little bit on the lower side. For headline, we're at 2.3, but for core, 2.4. We're seeing the Bloomberg Composite that's at 2.4%, the most recent survey of professional forecasters, though that is a little bit below where the FOMC was in their most recent SEP. So we're within the range, but a little bit to the lower side. Now, with this forecast, there are still some significant upside risks, particularly on the tariffs policy. We preview some of that in the Inflation Monthly this month. The only impact that we currently have in our baseline is a 35 basis point impact from various tariffs on China, but there's a lot of upside risks on tariffs, with tariffs on steel and aluminum scheduled for March 12th. That's not currently in our baseline. The 25% tariffs that were talked about with Canada and Mexico, we estimate that would be about a 30 basis point impact. That is not currently in our baseline. Those were announced on February 3rd that they would be delayed for a number of at least 30 days. There was also talk of the 10% universal tariff. We calculated that as at least 90 basis points, assuming that it excluded China. That is not in our current baseline either. Also, there was a talk of reciprocal tariffs. We do not have that in our baseline either, and that's another upside risk. There are the various America First trade policy investigations. That's not in our baseline. Those are supposed to come back in April 1st. And then there's possible effects of immigration and deportation. So right now, while we expect inflation to be coming down to 2.4% by March, data released in April, and ending the year at 2.4%, the risks are to the upside. I will leave it there and hand it back to you, Abby.
Thanks, Alan. Yeah, I think just a couple of other points from my side on the week ahead. Just in the data flow, we're expecting that real GDP in Q4 will be little revised from the initial estimate of 2.3% on Thursday. In the initial release, we were a little bit surprised by the kind of net export contribution being flat. We had expected that some of the kind of surge in imports of pharmaceuticals from Europe in the December advanced trade data would actually mean that you see more of a net trade drag in the quarter. So we see some risk that revises down in the report this week. But we do think there's some potential that you see kind of an upside from services consumption that could push in the other direction. So we ultimately left our expectations unchanged for a 2.3% print in the second estimate later this week. The other thing to note is we got the order and shipments data. We've been watching these data closely to try and ascertain, some signs of potential animal spirits. I think it's obviously something that people have been focused on after the election outcome and the potential for kind of improvements in investment. We did see some of the internals of the report looking a little bit better in the latest data, so that's something that we'll be watching when we get that data later this week too. And finally, we'll be watching the initial claims data closely too, just to see whether we can see any more kind of insights into the federal government job cuts that appear to be underway, given some of the reporting we've seen and the headlines we've seen. And I think that's a good point to kind of shift to the comment in the Economics Weekly that was published on Friday, where we're considering the kind of outlook for government employment. I just wanted to quickly run through the main points because it is an area where we've had a number of questions. So just to kind of put this into context, the government sector has represented 20 to 30% of jobs growth in the past 2 years in the US. And without it, non-farm payroll employment gains would have averaged around 132K per month in 2024. And that's according to the kind of published data, which could also potentially be overstating the strength of private sector gains. So it could, imply a relatively subdued pace of employment gains. And then if we think about the different policies that we've seen implemented so far and the implications for federal employment, if we start with the deferred resignation plan, this offered employees full benefits and pay until September for any federal employee who would accept the deferred resignation with no obligation to work after accepting the agreement either. And the Office for Personnel Management and press reports would suggest that around 75,000 employees took that buyout offer. The question here is when this potentially shows up in the data. With federal employees kind of remaining on the payroll until September, we could potentially see a lump of kind of employment loss in the October employment report. But it's a little bit unclear kind of when that will potentially show up in the employment data. The other policies of note would be the 90-day federal hiring freeze. I'm just going to share my screen because this is a policy that we actually saw put in place during the first Trump presidency. So during the kind of during 2017, when Trump first came into office, he put in place a 90-day federal hiring freeze. And when we look at the kind of job losses that occurred in federal employment after the hiring freeze was instated, in the following kind of 3 months, you saw a cumulative 15,000 jobs lost. And when we kind of look at that, that would imply around a 5K decline in federal employment per month. So we think that's likely to kind of show up in the February employment report in 2 weeks' time. It also has the potential to kind of hold down both March and April too. One of the areas, though, that is kind of harder to pin down and kind of put a precise estimate on is the potential implications from attrition. There's obviously a combination of policies that could impact attrition here, the federal buyout offer, but also the return to work mandate, which could potentially mean a rate of attrition that's somewhat higher than what we've seen in recent years. But ultimately, we think that you could see around 75 to 100,000 jobs lost via attrition. Now, we have to be careful here because 75,000 of that could also be accounted for in the buyout offer. So we don't want to kind of double count some of the impact there, but that's just a rough estimate of what recent attrition rates would imply in terms of the rate of kind of job loss in federal employment. And then finally, it's quite challenging to kind of pin down the precise estimates of the announcements that we've heard so far from the different agencies. Obviously, there was a flurry of announcements in the press around kind of the general reductions in force. But we do see, some federal workers do have collective bargaining agreement protections, and the rush of press reports would suggest a few thousand here and there. It's not necessarily adding up to kind of significantly larger numbers yet, but it's obviously something to kind of potentially watch. When we look overall and we aggregate up some of these different factors, we would guess that the administration could cut the federal workforce by the end of 2025 by around 200,000 jobs. That tally could be higher, but it's quite hard to know when we're looking at the kind of job announcements kind of coming through the press and coming in this kind of flurry. It's quite hard to know what they're going to aggregate up to ultimately. We could also see kind of further cuts thereafter as well. There's potential that we see continued attrition being higher. There's also potential that we see congressionally legislated cuts over time as well. So we could see cuts mandated by kind of spending cuts and budget cuts within Congress that would ultimately feed through into kind of slower hiring in federal government too. We could also see potentially cuts being lower. Obviously, we've seen pushbacks from courts. We've also seen some potential kind of offset for hiring being increased in certain areas where the administration is obviously prioritizing spending. In the reconciliation bills, we've seen increased spending for both defense and border security, for example, and so those are areas where you could see offsets from some of the kind of reduction in force announcements too. It's also unclear kind of how this might show up in the data. When we see the kind of first release of the data, it might not fully reflect the full sample, and seasonal adjustment in recent years we've seen can smooth through some of the slowing that you see in the employment data. So there's some potential that you could see seasonal adjustments kind of smoothing through some of the slowing in employment, and then we see ultimately revisions over time as the seasonal adjustment routines kind of catch up to that slowing trend. So I think that's the other thing to note. And then finally, we also noted not just looking at kind of federal employment, but also state and local hiring. When we looked at this in the report, there we go. When we look at this, we think it's not just kind of federal employment that could be poised to flip from positive to negative this year. We also think that we could see slowing hiring in state and local government too. State and local government accounts for around 87% of total government employment and is around 12.9% of total non-farm payroll employment too. We have seen state and local government spending slowing already. we've been tracking kind of the extent of state and local government construction spending relatively closely. This has been something that was a strong support through 2023, with this surging over 20% in the kind of 12 months of 2023. And then we've recently seen this actually kind of outright contracting when we look at the kind of most recent 3 months. So we have seen a big flip in terms of kind of spending at the state and local government level. And we think that that's potentially another factor that could see kind of overall government employment beginning to kind of slow as well. So overall, just to summarize, government employment, including state and local government, has been a sector that was providing substantial interest rate insensitive support to the expansion in 2023 and 2024. It contributed 30% of the strong job gains of 2023 and 20% of the job gains in 2024. And our sense is that strength, momentum, and support looks like it's potentially turning to become a net drag and a source of job loss as we go through 2025 and 2026. In the coming months, there are a couple of indicators that we can track to get a better sense of how these numbers are tallying up. We highlight these on pages 9 and 10 of the US Economic Weekly. I would just quickly note these. We'll be tracking layoff announcements from Challenger, Gray, and Christmas. We can look at both government, nonprofit, and then also at defense and aerospace for some of the potential impacts there. We can also track the daily treasury statements to see kind of outflows for federal salaries, to see how that's potentially slowing. The other place we can look at is the initial claims data. So we can look at UI claims filed in federal programs by federal employees. And then we can also look at initial claims just in those states where you tend to see an overrepresentation of kind of government employees. So we could look at kind of initial claims filings in Virginia, Maryland, and DC. So these are just a couple of the data points that we'll be watching to try and see how the kind of headline announcements of layoffs are feeding into some of the employment data that we can track at kind of a higher frequency. But overall, that's kind of all I had planned to cover in the call today. So I'm just going to quickly check whether there are any questions coming through. I don't see any. Amanda, Alan, do you see any? Nope. Okay. Well, that's great. All right. Well, if anyone does have any questions, please feel free to kind of reach out to kind of any of the people in the team. Thank you for joining the call this week, and good luck with the week ahead.